Hey guys, what is going on? Welcome back to the channel. Again, I want to thank everyone out there for all of your support on the channel. If you guys do like the content, if you guys do like the video series, feel free to like, share, and subscribe. And if you aren't a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, I thought I would once again talk about options trading, this time focusing more on what is called a covered call. There's been a number of viewers on the channel wondering how you can make extra income by selling contracts, selling options on stocks that you already have in your portfolio. So I thought I'd kind of go through that in more detail. Again, options trading is not for everyone. I've been putting out a number of videos talking about introducing the channel to options trading. It's very, very complex. It's much more complex than simply buying and selling individual securities. But I think covered calls is probably the easiest type of options contract to understand. You simply have to have stocks in your portfolio, and then you can sell those stocks off in contracts. Essentially, you are obligating yourself to sell a stock at a particular price. But in doing that, in lieu of doing, for example, a limit order for that same exact order, you get paid to do that. So we'll kind of go through today's video, going through what a covered call is in more detail, as well as doing one on the portfolio. As you can see here, there is a white background to the portfolio. We are in active hours trading. So we'll kind of do a real options trade here, going through, again, a covered call on how to utilize covered calls to make extra income in the portfolio. Now, if we scroll down here, you can see I have a number of pending options trades here. The majority of these are covered calls. Let's kind of go through each of these separately. You can see here I have a call for AT&T, ticker symbol T up on top here. Essentially, this contract, you can see T, $35 call, $4.27. So what this is saying is that I have basically put in a contract, I sold off a contract to sell AT&T at $35 a share on or before $4.27. If AT&T does not get up to $35, which you can see currently bottom left, it's at $34.99, almost right at the call strike price, I would have to sell this stock off from my portfolio to another investor for $35 per share. But that's fine. I've already sort of committed to doing that. And by doing that, you can see in the middle there, I have an average credit of 50 cents per share. Each contract is 100 shares. So essentially, each contract I have been paid $50. And you can see this on the bottom here. $35 call, sell, $4.27. I executed this trade on April 23rd, and you can see a credit to the portfolio of $100. So again, I want to break this down very, very simply here. I did a contract where I'm obligated to sell off AT&T at $35 a share. Each contract is 100 shares. And for doing that, for making this contract, for selling this contract off in the market to another investor, I got paid $50 for each contract. So 2 contracts means a credit of $100 to the portfolio. I did another one for Ford here. Again, you can see F, $11.50, call, $4.27. So again, I sold off a contract in which I am obligated to sell Ford portfolio to another investor for $11.50. On the bottom here, you can see that for that trade, I was paid $4 per contract, or 4 cents for each share. Again, each contract is 100 shares. If we go to the bottom of the portfolio, you can see that credit there. That trade was executed on April 23rd, 2018, 11.50 call, sell, $4.27. So again, I'm obligated to sell off to another investor for my portfolio to their portfolio at $11.50 forward if it were to get up to that price. So that is really what a call is. We are taking stocks from our portfolios and essentially selling a contract to the market saying that we will sell off a stock at a particular price if the stock gets up to that price. And for doing so, we get paid for that contract. And let's kind of go through, again, how this is all done. If you have taken a look at my other videos, I go through some of the mnemonics I use for kind of figuring out what we're doing with all of the different contracts. Again, I only want to focus on doing a covered call, which is up on top there. We are selling a call. And I kind of think of a call as sell. So if you're selling a call, you are obligated to sell a stock at a particular price. If you sell a put, for example, I think of put as buy. So P-U-T-B-U-Y. is the way I remember that. C-A-L-L-S-E-L-L. Call, sell, put, buy. And when you're doing a sell contract, you are obligated to fulfill that contract. But again, let's just focus on selling calls, which is also called selling covered calls in this video. The main thing that you need to realize is that you have to have the number of shares that you're selling off. So every contract is 100 shares. If you want to sell off a contract, you have to have 100 shares in your portfolio to do so. So for example, let's say I wanted to do another call at $11.50 for Ford. You'd simply put in the number of contracts you want. Again, each contract, as you can see in the middle there, is 100 shares. I would be paid 5 cents per share for this particular contract. My credit would be $5. So a credit of $5 would be put into my portfolio. And then that expiration date up on top, right under sell Ford 1150 call, you can see is 4/27. So this contract would be good until the end of trading on 4/27. So if the other investor wanted to execute this trade, they could do so, and I would be obligated to sell off a stock at $11.50. So if the stock went up to $12, this would benefit the person who had bought the contract from this portfolio, from my portfolio, because they could buy Ford at $11.50 when the stock was trading at $12. I would be losing money, but again, I've already kind of committed to selling off Ford at $11.50, so I'd still be happy about that. I would definitely lose on the opportunity, but again, that is why I got paid that credit. There is a risk, an upside risk potential of selling a stock off for lower than what is currently trading for in the market. Another very important thing to consider is that there are not always going to be people willing to buy whatever contract you're selling off. So for example, the $11.50 call here in the middle, if we click way up on the right hand side figure, it opens up all of the bids for this contract. And you can see currently there are 762 bids at 4 cents per share. So basically $4 per contract. Again, each contract 100 shares, 100 times 4 cents is $4 per contract. There are currently 762 contracts that are pending. There are none for 5 cents. So if I were to put in this particular contract, one contract, limit price 5, credit $5 to the account, this would not execute because there are no contracts open for this. Let's kind of go ahead and do this just to make this clear. And again, in the middle there, you can see I am agreeing. And I'm really obligated to sell 100 shares of Ford at $11.50 per share before or on April 27th, the expiration date of this contract. If I'm not asked to sell my shares of Ford by then, I'll be able to keep the collateral, the 100 shares of Ford that I have, as well as the full $5 credit that would be given to my account for making this contract. So if we swipe up here, you'll see that this will not execute because there are simply no bids for 5 cents per contract on this particular order. If we go to the bottom here, we'll see that this is pending. There it is, $11.50. The order is placed. It is not fulfilled because, again, there are no bids open currently for 5 cents per trade. If I were to go back, for example, I do another option. Again, we are going to be selling off the stock, selling a call, again, called a covered call, April 27th. Let's see if this will update here. Go back to $11.50 call. So again, I'm willing to sell off 100 shares of my portfolio at $11.50. If I were to put one contract and then change this to 0.04, $4 credit per contract, 4 cents per share, and I were to execute this, this would execute because, again, if we go back up to the top right graph, you can see there are currently 697 contracts that somebody is willing to buy for 4 cents per share or $4 per contract. So that is still open. My particular contract, which I put in, again, let's go all the way back to Ford here, is still pending because there are no contracts for 5 cents per contract currently. So that is what is called a covered call. That's how you can make extra income from your portfolio. Again, you have to have 100 shares of whatever stock that you're going to be selling off for this. And again, you are simply doing a contract to sell off 100 shares of your portfolio at one particular price. It gets very, very complex with regards to figuring out the risk and reward for every trade. If we go back to Ford, for example, go to trade, view all options. Again, we'll be doing a covered call we'll be doing a sell call. Again, you are doing a contract where you are basically obligating yourself to sell a particular stock at a particular price. And you can see there are a number of different prices that you can sell off here. If we go up to $16, you'll see all of these, if you click on that graph in the upper right hand corner again, have 0 bids. So if you put in contracts on these stocks, these will never be fulfilled. Again, we'll do the contract here for $15.50. Again, upper right hand corner graph. You can see bid, there are 0. Again, up into the upper left, bid, $0 times 0. There are no investors willing to buy that from an investor, from yourself, if you were to put in that contract. If we go back again, $14.50 call, graph up in the upper right hand corner. Again, for bid, you can see that there are 0 contracts that anybody is willing to buy. So that is why if you put in a contract, you got to make sure that there are other investors willing to buy your contract. A lot of the contracts on Robinhood here have 0 bids, meaning there are no investors that will buy your contract. And again, you can see that this is currently on April 27th, but we can scroll over to May 4th for the expiration date, May 11th, 18th, so on and so forth. And the farther you get out from the current date, the more risk you have, so the price of the contract will increase. Let's go all the way over to January 17th, 2020. You can see the $12 call in the middle here. You will get 88 cents per contract. But if you go to 18th here, you get 46. December 21st, you get 43 cents. So as time shortens here between the current date and the contract expiration date, there is less risk for the person selling the contract, and hence you'll get less money for that particular contract. The more time between the current date and the expiration date of the contract, the more risk it is for the seller, the more money you'll get for a contract. So that is how you do covered calls. Please let me know if you guys did not follow this video. I wanted to break this down very, very simply here. Again, with a real example of doing one of these covered calls. Again, I sold off today, or at least I put in an options contract to sell off forward at $11.50 on or before April 27th. And in doing so, I would get $5 credited to the portfolio. That has not yet happened, just because, again, if we go back to the contract, trade, view all options, we want the sell a call. If we go down to the $11.50 call here, go up to, again, to the upper right-hand corner where there's the couple bars there with the graph, you can see currently the bid price is 4 cents. Now there's 820 shares, or excuse me, 820 contracts for this particular contract. There are no bids for 5 cents. If it did get to 5 cents, then my trade would execute, and I would be obligated to buy, or excuse me, I would be obligated to sell forward at $11.50 to another investor. So I hope that makes sense. Again, I wanted to do this video as there have been a lot of questions about how to do covered calls. Options trading is very, very difficult to understand. I've been trying to do some very simple videos explaining this to everyone on the channel. Again, if you guys have any questions about this, please let me know. I'll do an updated video specifically about any question that you guys have on exactly what we're doing here. Again, I'm only focusing on one of the many different types of options contracts you can do. Selling a call, which is called a covered call. You have to have the stock you want to sell the contract for in your portfolio. You need to have 100 shares of that stock. If you have those, you can sell off those stocks via a contract, via an options trade to another investor, and in doing so, you'll get rewarded, you'll get paid for doing that contract, as we did here with Ford. We went ahead and put in an order for 100 shares of Ford to sell off at $11.50 on or before April 27th here, again in the middle. And if we do get this contract executed, $5 will be credited to the account. 5 cents times 100 shares equals $5. So let me know if you guys are doing any of these covered calls. Again, let me know if this is too complex for you. I can definitely break this down in a little bit more simple fashion. I have put out a pretty detailed video, again, about 3 weeks ago, talking about all of the different options contracts, specifically focusing on selling off calls, selling covered calls on stocks you have in the portfolio to make extra income on those stocks. So yeah, just wanted to quickly go over that. I know there's been a lot of questions on the portfolio. Again, please let me know if you guys do not understand exactly what we're doing here. I'm always open to doing an updated video, kind of explaining this into more detail. based on what your questions are on options trading. So not to make the video too long or too complex, I'll kind of end it here. Again, if you guys enjoyed the video series, if you guys enjoyed the content on the channel, feel free to like, share, and subscribe. And until the next video, we'll see you then.